Recording in progress.
Welcome to Trading the Markets. My name is Woodrow Joseph. I'm here to show you guys just lessons on the overall stock market, what it is, what's going on, and just something for beginners, intermediates, and as well as people who are completely new or completely know what they're doing. So I'm going to start off with some slides. Let's see. Alright, so you're gonna give people I'm gonna give it like a few more minutes to see if anybody else will log in, and then we're gonna get started in a few. But definitely, if you have any questions, let me know. I'm gonna drop my Discord link in the chat. Actually, I already dropped it. So we'll get started in a few minutes. But this is what we're gonna be talking about. What is a stock? Alright. Let me just send some more text, see if people are logging in. If not, we'll just get started. Whoever comes, comes. But how you doing? Thanks for joining, Crystal. Hey, glad you can make it. Since you are a beginner, I could just start with you and then see if people come. No problem, anytime. We're gonna start doing this every week and probably have more classes. Yeah, give me one more minute and we'll start. One more minute. Stay here. Yeah, start. Yeah, this is more detailed. Alright, so I'm gonna start here first. Alright. And then alright, we're just gonna get started. I think somebody is trying to log in. Hold on. Alright, let's just get started. They got the link. Whoever shows up, shows up. So, alright, so starting off, what is a stock? So, a stock is basically just a piece of ownership of a company. So you think about it, why would anybody own stock? Let's say you have a business and you're trying to raise money. Well, you can go door to door, ask your mom, your relatives, everybody to invest in your company. But when you get big enough and your company's known, you could do what's called issuing stock. So when you have stock, you're basically given a piece of ownership of your overall company. So stocks, bonds, option contracts, shares, these are all securities. So securities are a way for you to invest in actual defined businesses. All right, so like I was saying, so it's called shares because you can share in the growth or decline of the company. So that's why it's called shares. You share in the profit or the losses. All right, so that's basically what a stock is. Any questions? Is that clear? All right, I'll move right along. So why would anybody buy stocks? Because stocks offer investors the greatest potential to grow. So if you look at stocks, like over the past say 10 to 15 years, the S&P 500 has returned about 11% consistently. So just to show you what I mean by that, this is a chart of the S&P 500. As you can see, back in 94, this was $44 a share. Then in 2000, it went up to $152 a share. So if you notice it, it's rigged. The stock market always goes up. Every time it goes down, it always comes back harder. So this is why you want to invest in something that's just going to carry you through over time. Because in the stock market, time beats everything. So over years, if you had invested, let's say you see this, right now the S&P 500 is at 743. Back in 93, it was only $44. And then back in 2009, you see it was $75 a share. So from 2009 till now, it's 10x. So if 2009 you had put some money in it and you never touched it, whatever you put in would have 10x grown. So if you had put in $10,000 in 2009, you would have had $100,000 today. That's why the stock market is important, because it represents the whole United States, all the companies. All right. So now So here's what you need to know, right? So basically, there's about 8,000 to 12,000 stocks in the whole stock market, but only about 2,000, only 2,000 of them make any money. And just to make sure you can hear me, right? Everything is clear. You can hear me. I'm not just talking to myself. Just want to make sure I'm heard. All right, good, good. All right, because I would have had to say everything all over again. So, like I was saying, out of the 12,000 stocks in the whole stock market, only 2,000 of them make any money. So most of the stocks, they're duds. They don't do nothing. They don't make money. They're just a waste of space. So out of that 2,000 that make money, 500 of them are in the S&P 500. That 500 stands for the top 500 companies in the United States. They're all inside of one index. Index is a basket of stocks where all the stocks are inside of one name. That name is called the S&P 500. All right, that's also known, which is also known as SPY. So, like I was saying right here, so if you look at it like this is the S&P 500 represented, and you see how over time, like even if you go down to, so you see, I think I said 2009 it was 50, and then 2000, right? So COVID, remember COVID? So even in COVID, you see before COVID, it was almost at 300. Then it dropped down to 230, 236. But look what happened from 2020 all the way to 2021. So in 1 year, it went all the way to 400, almost doubled in a year. And then you notice in 2021 we had another crash, went from 450 all the way down to 350. And as you can see, within the next year, it already came back, and then it already doubled from then today. So, like I said, in order for this to crash and never come back, the United States would have to be over. All the government would have to shut down. It would be like the end of the world type of Armageddon type of situation. So going back to what I was saying, so those are called indexes, the baskets that hold groups of stocks. So on top of the S&P 500, you have something called the Nasdaq 100. So let me show you the chart. So you can find it through the ticker. So this shorthand letters that represent stocks. So QQQ. This is the Nasdaq 100. This is all the tech stocks, and you see tech has also had a crazy growth too over the decades. And then on top of that, you have the Dow Jones. So the Dow Jones is the industrial stocks like Caterpillar, Lockheed Martin. So the industrial companies that build the structure of the United States. So like here's an example of the Dow Jones, DJIA. So this is the Dow Jones. Hold on, no, I mean Dow Jones. So DJI, yeah, DJI. So yeah, this is the Dow Jones. As you can see, since this goes back to 1987, the year I was born. This was, let's see, it's so tiny I can't even really see the price. Hold on, let's zoom in a little bit. All right, so back then, $46 a share. Back in the year born. So my parents had made invested in the Dow Jones, $46 a share. Now how much is it? How much is it? 50,000. So imagine if since birth I had done that. But let's just not even say since birth. Let's just say since like 2010. You see, it already 7 times 5, already 5x from 2010. So this is why long term, like instead of putting your money in the bank, put it in something that's steady, that's stable, that's gonna grow over time. All right. So now going back to this. So there's 11 sectors in the stock market, right? So you have your tech, information technology, materials, real estate, utilities, communication services, consumer discretionary, consumer staples, energy, financials, healthcare, industrials. But the main thing for you to notice is that they're not equally split. So the biggest and thickest weight is in tech. So just about 30% of that S&P 500 is in tech. Tech is the highest beta, the biggest mover. Tech basically rules the market. You could say that because that's your Nvidias, that's your Apples, that's your Microsoft, that's all your big companies. You know, include. So then from tech you have, let's see what's the next biggest, financials. So financials, your next biggest, that's all your banks. You know, J.P. Morgan, Wells Fargo, Citigroup, all your big banks are inside of financials. And when it comes to the way the market moves, Usually financials feel it first. Usually if the market's gonna crash, financials drop first. If the market's gonna go up, financials go up first. They're usually the first ones to go. Yep. You have a question? Go ahead. I don't know if you want to talk, unmute your mic, or type it. But if you have a question, you can definitely voice it. Yeah. If you want to type, you can type it. If you want to unmute, you can unmute, and we can answer some questions. All right. So, like I said, so tech. Then after tech, oh, he's trying to come back in. All right. Let me know if you're able to talk. Hello.
Yes.
Yes. You have a question?
Hi. So the second largest sector is actually com services.
Oh yeah, you're right. You know, it does change as time goes on because they're always adding and taking companies out of the S&P 500. So it's basically like you got to make the team. And some people, if you're on that team and you're not, say you're part of the S&P 500 and you're not performing, they're gonna kick you out. So that's why sometimes it rebalances. So it used to be financials, but now it's communication services. Okay, and then financials, and then healthcare, and then oh no, consumer discretionary, then
Right.
healthcare. Yep. But let me know if I'm missing anything. Yeah. So, go ahead. You had a question?
No.
Okay. Hey, what's up, Trubs? Glad you can make it.
What's up, man? It sound like you're in the back in the shower somewhere.
Oh, maybe it's because of my Bluetooth speaker. Let me turn that off.
Say that again. I can't hear you at all now. Can
You
you
guys
hear
can't
me?
hear me at all?
Yeah, there you go.
Okay, okay. Yeah, it probably just took a second to turn off the Bluetooth speaker. But yo, I know it's been a minute since I did one of these classes, but I have some time, so I want to get back into it.
Yeah, yeah, man.
Yeah, but how you been though?
I've been cool, man. Same old. Just working. Got me a swing shift scheduled job now, so I work 2 to 10:30, so I could be home during the market.
Okay, okay, yeah. I see that you've been active. You've been killing it. I gotta give you your props.
Yeah, I've been getting a little better, man. Just need to slow down and get a little faster. Get my account management better. You know what I'm saying? But I've been get adjusting a little bit. You know, I've been pretty much getting better, except had to get the over trading in check. That was my main problem.
Okay, okay, okay. Gotcha, gotcha. All right, so I'm gonna run a quick, beginner thing, for the beginners, and then after that, I'll get more into intermediates and people that are a little bit more advanced on like what's going on now in the market and stuff. But I'll just finish again going through this. So let's see. So what I wanted to, all right, so this is what I want to show. So the difference between investing and trading. So investing is long term. You don't got to watch it as much, and it's more about the long term concept, long term time frame. So any fluctuations that's happening, you're not concerned. If the market dropped today, you're not worried because you're thinking about the next 5, 10 years of holding an asset. Because you know that if you hold it, time is gonna be everything. So like I started trading in 2020. So when we were looking at the SPY chart, 2020. Let me go on SPY. Right. So let's look at this. So in 2020, after COVID, the market was at 240. Now it's at 737. So is that more than double, almost triple. So the market almost tripled. So basically, if I had just put all my money into this S&P 500 and didn't trade, didn't do nothing else, my money would have tripled from me just doing nothing but holding. All right. So that's the benefit of long-term investing. Now trading is short-term, but you got to monitor it more often. You got to be more active, and you're focusing on small movement. So basically, you get paid off movement. So you're not worried about, oh, the market's crashing today. No, it's about when did you get in and when did you get out. So if you got in right here, and you got it right here, and you wanted to go up, you'll make money. But with trading, you can make money whether it goes up or it goes down.
That's the difference. With stocks, it's in order for you to make money from it going down, you got to have a lot. You have to do something called shorting, which is way more complicated. But usually, people only make money from it going up. So that's the difference. And you can use fundamental analysis on stocks. So fundamental analysis is comparing the income statement, the debt, the profit, and the growth of a company, because you're trying to see under the hood how healthy is it moving forward in the future. But now trading, you're just looking for quick moves up and down to just take advantage of. So you don't really care about the real health of the company for the long term. All right. So then after that, I want to go over the anatomy of a candlestick. So candlestick is how we keep track of the movement of price action, how the prices are moving. We could use a line graph right here, right? But the line graph doesn't tell us certain information that this tells us. So this gives you 4 bits of information. For every single time period, you're going to know what price did it open at. So for the green one, the bottom is the price that it opened at. The body, so the bottom of the body is the price that it opened at. The things on the ends, those sticks, they're called wicks. That just tells you the high and the low for that period. So for example, on the green one, let me do a little annotation on this. So for the green one, the price opened up here, it went lower, then it came up, made a high, and then it finished and closed there. So where price actually open and close is determined by the body. The bottom of the body is the open, the top of the body is the close for the green candles. Oh yeah, green candles go up. So it opens lower, it goes higher, and whatever happens in between, the highs and lows are being shown. So from a line graph, you wouldn't know what the high and low was for that period. It just averages out the period and shows you the average price for that period. So this is good because you want to know who's winning the fight. So in every candle, it's a fight between the bears and the bulls. I don't know if you can see the bear. Yeah, there you go. So it's a fight between the bears and the bulls, right? So the bulls, it's up and it's stuck. And then the bears, they climb down the tree. Like that's one way you could think about it, right? Bears means it's gonna go down. Bulls means it's gonna go up. So now if you go to the bearish candle, the candles that go down, the open is the top of the body, right? So then a candle can open at this price. It might go high, make a high, then come back, come down. Let me annotate. Then it might come down. Hold on. There we go. Then it might come down, and it might make a low. But then by the end of the time period, it closes right there. So does that make sense to you, Chrissy, or is it a little confusing still? All right, good. So that's how you judge the candles. So now let's look at some examples. Let me stop annotating. All right. So look at some examples. Let me erase this. Hold on. All right. So looking at some examples, right? So right here, you see the candles. You see the red going down and the green going up. So you see it goes up into this area, and every time it goes into that area, it gets pushed down. That's called a resistance. Resistance is like the ceiling, So a lot of time, price moves in a range. So it always moves between a floor and a ceiling. Think about it like that. So resistance is the ceiling. Whenever it goes into it, it has a hard time busting through the ceiling and tends to reject and bounce down. But support is the floor. So whenever it hits the floor, it tends to bounce up from the floor. So if you find something that's trading back and forth, look for the floor and for the ceiling. So what you do is whenever it hits the floor, you buy up. Whenever it hits the ceiling, you sell down. Simple, right? Any questions? That's clear to you? All right. I'm just assuming it's clear. All right. So the floor and the ceiling, all right? Okay.
Can you repeat that part, please?
Okay, so resistance is the ceiling. Whenever price hits the ceiling, it always gets rejected. You know what I mean? So it tries to bust up, it fails, gets pushed back down. Comes to the ceiling again, just like in the house. If you're hitting the ceiling, throw a ball at the ceiling, it's always going to come down. It's going to bounce off the ceiling. Now the floor, same thing. You throw a ball off the floor, it's always going to bounce off the floor. So when you're looking at a stock, you want to look at the candles and identify the big picture. Where is the ceiling and where is the floor? Because if you know where they are and price is moving between them, every time it hits the floor, you buy, it's going to bounce up. Every time it hits the ceiling, you sell, it's going to go down. Because in options, you can make money off of going down too. That's why I said if it hits the ceiling, it's going to go down. Is that clear? All right, good. So this is what you call sideways. This is not what you call a trend. Now I'm going to show you the difference between a trend. So let me erase this. So this is a trend. Click. Hold on. Stop annotating. All right, so look at this right here. It's a trend. So the ceiling and floor is not always horizontal. It could be diagonal. You see what I'm saying? So you got to be able to identify where's the floor. So notice that where these arrows is, that's where it couldn't break out of. So that was the ceiling. That was the ceiling. That's resistance. And then on the bottom, you see where it bounces from. That's the support. So you got support and resistance, not just horizontal, but also diagonal. It's important for you to know that. Now, what's important now is understanding trend. So the trend is your friend. The trend is the direction. Is it on a downtrend on the left or uptrend on the right? How do you know? You have to look at the pivot points. Where does this swing from? So if you look at the structure, let me annotate again. Look how this is. How do you know you're on a downtrend? Because you're making lower highs and lower lows. So notice that the highs are getting lower. You see the highs? They're getting lower. You see the lows? They're also getting lower. So lower highs. All right, so I'm gonna just join. So lower highs and lower lows means you're on a downtrend. All right. So you have to look at the big picture to see where is the highs and the lows. That's all you got to do. Now for the uptrend, notice that it's the opposite. So now you're looking for higher highs. What's up, Mike? Higher highs.
Hey, how we doing?
Doing good, doing good. Just going through the intro. And then after that, we can talk more about like the state of the market and what's going on.
Awesome. Just lost track of time. So
Are you good, buddy? You good?
Yeah.
Yep. So on the uptrend, you got higher highs and higher lows. So now look at what happens to the highs. They're getting higher. Before they were getting lower. Now they're getting higher. So it's higher highs, it means uptrend. And then also the lows are getting higher. Any questions, Chrissy? Is that clear? Clear? All right, good. So that's how you, so when you look at a chart, you could tell if it's an uptrend or downtrend. Like, let me stop it. Let me erase these. So if you look at the S&P 500, is it on an uptrend or downtrend? Pretty clear, right? I know you said uptrend. So that's been on uptrend first. Now I'm gonna put the candles on so you don't get confused. Here's the candles now. All right. So this is a monthly candle. Every one of these represents 1 month. Notice this is April 2025. This is May 2025. So I can change the time frames to look at what the information is telling me. So for example, on this candle right here, notice that it has a long stick at the bottom, the lower wick. That means that if you look at this candle, and you look at these numbers at the top, it'll tell you like, so if I click on this, you'll see that it opened. How do I make that stay? Hold on. I'm trying to move this so that you can, okay. Well, so the first number up here, let me annotate. This is the opening price. Oh, see, every time I click, it moves. Okay, so I can't do it that way. All right, so I'm just gonna do it manually. So since this is a red candle, the opening's at the top. So you see on the right side, this candle opened at 550. You'll see that it made a high at 560, because that's the top of the stick, top of the wick. The bottom of the wick, that's the low that it made for the month. So the high for the month was 560. The low for the month was 478, right? But by the end of the month, it closed at 547. So you see how this candle is showing me 4 bits of information. And think about it like this. Because remember I said every candle is showing you the fight between the bears and the bulls, you know? So who's winning the fight? So look at it like this. I'm gonna draw on this. Hold on. So right here, when the price opened, the price went up first. So the bulls were in control. But then the bears said, no, no, no. They pushed it down all the way out there. So now the bears are in control. And then the buyer said, no, 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 push it back up. So by the end of the month, it was neutral because it barely moved from where it opened at. So this is how a candle is showing you who's winning the fight. That way you can make better informed decisions. So let me erase this now. All right, let's move on. Move right along. So now this is something that's very important. Spotting reversals, right? So reversals tend to give you the best risk to reward, where you're risking very little to potentially make a lot of reward. So notice that what happened is that in the beginning, it was making lower highs. The highs were getting lower, the lows were getting lower, right? Highs getting lower, lows getting lower. But then what happened right here? The low, it made a higher low, right? And then you see this high right there, it made a higher high. So at that point, it's confirmed that, hey, we're no longer on a downtrend. We just transferred to uptrend. Does that make sense to you? So at this point right here is where the trend changed. It stopped making lower highs and lower lows and started making higher lows and higher highs. So this is how you can spot a reversal, is when you see the structure. This is called market structure. You're looking at the overall structure to see where it's going and how it's moving. So that's basically, higher highs and higher lows explained. I think Treasure's still trying to come back in. Let me see it. Yeah, I think, yeah. All right, so that's higher highs and higher lows. Now, let me erase this. We're gonna go into options in a little bit. This is all overall knowledge. All right, so now went through this. Okay. So what is a stock option? So a stock option is what's called a derivative. That means it derives its price from something else. That's something else called the underlying, which is the stock. So stock options get their pricing from the stock, right? So think about it like this. You got tomato and you got ketchup. Ketchup comes from tomatoes. So ketchup is a derivative of tomatoes. All right. So that's just an easy way to explain it. And once one option contract, it locks in the price it locks in a specific price for 100 shares of a particular stock. So the whole purpose of options really is to buy stocks. You're locking in the price because you know that later on it might go up, but you still want to be able to buy it at that lower price. So if you lock in the price and you want it to go up, that's called a call. But if you lock in the selling price, which is the opposite, because you can lock in the selling price so that when it goes down, you can still sell it at a higher price. That's how you make money off it going down. All right, is that clear, or is that still a little confusing? Let me know. I'll slow it down. But so that's what an option contract is able to do. It's able to lock in either the buying price or the selling price, so that when it moves, you're locked into a position. So that from that position, the movement that happens after could be your gain or your loss. All right. So option contracts, they're not shares. Like I was saying, you're either locking in a buying price or a selling price, and you have to lock it in by a certain time. So it has an expiration date. So the way I explain this, right? Remember, the whole purpose of the option contract is to buy the shares, but you never actually have to buy the shares, because If the shares go up, the price that you paid for it goes up, so you can make profit off of what you paid for it. So, for example, let's just say a stock is at $1, right? And you think it's going to go higher, so you want to lock in that $1 buying price. So then, when the price goes to $2, you have the right to buy it at $1. But now this contract, you pay a premium, you pay a price for it. So let's say you pay $50 for the $1 call to lock in that $1 price. So now by the time this goes from $2, what you paid $50 for is now going for $250. So instead of buying the shares for $1, which the contract gives you a right to do, you just sell the contract back to the market. Is that clear or is that confusing? Let me know, Chrissy, because this is not easy to explain. So basically, yeah. So like I was saying, it's like sex and condoms. So the purpose of sex is to procreate and have a baby, but you can just take the pleasure from the sex, which is the profit from the stock, instead of actually getting the baby, which is buying the stock. You just take the pleasure, which is the profit. That was just something I came up with. I don't know if that makes it easy to understand, but let me know if you guys think. All right.
It's definitely a unique analogy.
yeah. I had to think of something because it's not easy to explain. So I had to think of something that people could relate to. And not to say that's what you guys are doing, but hey, that's what I could think of. So yeah. So then I'm talking. So option premiums. So in order to buy the option, you got to pay what's called a premium. So that's the price that you pay to buy the contract. And when you look at the premiums, one contract locks in the price for 100 shares of stock, like I said. So the premium price are listed per share. So remember, since it locks in 100 shares, you'll see the premium at, for one share. So let me show you examples so you can actually see what I'm talking about. So let's say if we want to trade the S&P 500 right here, you see it's going for $7.36 a share. So now I can lock in the 730. If I think, let's say by June 8th, well, June 8th already, that's tomorrow, right? So by tomorrow, well, let me give it some more time. It doesn't really matter the time, but I just kind of want to give you a decent example. So let's say June 10th, right? So is that Friday? What's the date on? What's Friday's date? Friday's the 12th. So let's say by Friday, I think this is going to go up. So I choose the Friday expiration date. Now, if I think it's going to go up towards 738, you'll see that this is going for $6.16, right? But that $6.16 is for one share. Remember, this locks in 100 shares. So the real price to buy this is $616. You see that? So whenever you see option prices, you multiply it by 100 to tell you how much it would cost to buy it. All right. So let's say I was to buy this. I'm going to add it to my watch list, right? View my watch list. And I'm going to look at the price of these contracts. What's the spice? Was it $7.38 right here? So $616 to buy one contract of the $7.38 call. But it doesn't have to move as much for you to start making money. So let's just say I go to simulate my returns. Let's say I buy this in, let's say by the 10th. Let's say it gets there by the 10th, right? So let's say the 10th let me make it shorter term. Let's say by tomorrow, right? Tomorrow, let's say I already had this, right? And then tomorrow by the time market opens, let's say by 11 a.m., right? So by 11 a.m., so what I did, that shows the time, right? So if I bought this, I'd be down $36, which is 5% if I had bought this on Friday, right? Now, let's say by the time the market opens, this goes to $7.39. I'd be up 10% from this. And if it was to go higher, say $7.41, as you can see, the higher it goes, the more money you'd make and more percentage you'd make off your contracts. So that's the name of the game, movement and time. So the difference between stocks and options is it's not enough for you to know it's going up. You need to know how much it's going to go up and by when. So that's the difference between it, right? All right, so we got about 3 minutes left. And then what I'm going to do after this, I'm going to go back on and I'm going to do the intermediate class. But this is all beginner stuff right now. We got about 3 minutes. Any questions? You guys have any questions? No? All right, so to get started, right, you want to open either a cash account or a margin account so you can go to Robinhood, Thinkorswim, or Webull. Those are my top 3 choices. So, and then you just get a cash account or a margin account on these platforms. Then when you start trading, I would like for you to focus on just one stock and one index. So focus on S&P 500, then pick a stock inside the S&P 500 to focus on. You want to start looking at it every day, and you kind of get to know how it moves, and it becomes like the member of your family. Like that's like a good way to get started, to get familiar. Then you can focus on one time frame. So time frame, so like I was showing on this chart, this is the monthly view. I can go to weekly. This is oh, hold on. My fault. So this is the weekly view. If I go to 1 week, see, it just broke down. So one candle is now 4. It broke it down to 4. Or I can go to the daily, where one candle gets broken down to 7. So, oh, my fault. I keep switching the ticker. SPY, go back to SPY. So now I can go on the daily, where now every candle represents each day. So as you can see, on Friday, the market came down big. It went from 752 all the way down to 732. And you can see it took it 2 weeks to get up there. And one day it ate up like 2 weeks of movements. So, and during this day, actually, I can show you guys this on my watch list. We got 1 minute. This is the last thing I'll show you guys. Where's Robinhood? Where did I just open up? Oh, right here. So, if you go to my watch list, all right, the last thing, let me see if I can do this before it closes. Kind of moving slow. All right, let's see, where is it? 729 pie put. Yeah, let's just look at this one. So look, these went from 100 to 200. That was another one I just didn't have time to show you guys, but it went from 100 to 1700 off of that drop. So that's it for the beginner class for today. I will have more classes where we're going over more stuff, but thank you for coming, Chrissy, Mike. If you want to get back on, Mike, we could talk more about like what's going on in the market now. Or Chrissy, you can come back if you want to, huh?
Let me blast.
Say that again.